Hi everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi Debbie.
Hey, hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And today we're going to talk about a company in the advertising business, but it's a different type of advertising. It's those billboards that are out there, yes? And we're going over Lamar advertising, and it has some unique features, so let's get into it. Okay, Debbie, let's get into Lamar Advertising, which is a REIT. And you all know that REIT stands for Real Estate Investment Trust, which means it has to take 95% of its profit and give it out in the form of dividends. And we're going to look at that dividend in a moment. Debbie, let's see what Lamar Advertising does.
All right, Lamar Advertising Company owns and operates outdoor advertising structures.
Billboards.
In November of 2014, they changed its corporate structure to a REIT. At year-end in 2018, it operated approximately 156,900 billboards, and they display in 45 states in Canada, including 3,100 digital billboards. The company also manages highway logo signs with about 149,000 logo displays in the U.S. and Canada. Sales breakdown by industry group is service at 13%, restaurants at 11%, retailers and healthcare 10% each, and they employ about 3,600.
And the first thing we want to look at is that clean surplus return on equity. And folks, look at this. It is going up. So that means that the earnings are increasing at an increasing rate each year. So that's very, very unique, and it's very, very good for the price of a stock. Now, remember that this company is a real estate investment trust, in that 95% of all the money it makes after expenses, of course, have to go to the shareholders, 95%. And that's why these REITs are so high in their dividends. And this company is unique in that it has the ability to raise prices as inflation increases, because it's the cost of advertising as more and more cars are on the road and those billboards become worth more and more. Now, we look at the retention rate, and of course the retention rate is about zero. In fact, it's been a little bit negative over the years. And that's because it's giving all the money out in the form of dividends because it is a REIT. Now, the net income growth is really pretty good. And let's go all the way over here to the net income. That is, if you're using a computer or a handheld device, and you can see these charts, and you can see that this net income has been going up and up and up. And that's really, really good. And boy, oh boy, we're considering this stock for our dividend growth and income portfolio. And over here at the revenue growth, we can see the revenue growth, the average over the past 5 years is about 5%. Now, that's below the average stock in our database. The average stock in our database has a revenue growth higher than this, but don't forget that we are talking about an income stock here that has growth with it. Now, what we don't like is, let's go all the way back over here to net income, and that is in the recessionary years of 07, 08, 09, this stock stumbled quite a bit. In fact, it had negative earnings back in 2009 and 2010. So that is the only thing that is bothering us about this company is next time around, will it be able to stay positive and continue to pay those dividends? But really, for the past 10 years or so, this stock has been looking pretty good, folks. And then when we look at the stock's return over the past 1 year, with the market doing just about nothing, yes, folks, the market has done nothing in this past 1 year, this stock is up 10%, and that 10% does not count the dividend that it's paid out of almost 5%. So the total return on this stock is a little bit over 15%, which is pretty nice. And then when we look at 5 years, we can see this stock is up about 55%, while the market is up about 49% over the past 5 years. So in other words, we have a stock that's paying a 4.9% dividend, but yet is still outperforming the S&P 500. That's pretty decent. And then when we look at the averages, the market averages, we can see that Lamar has a clean surplus return on equity of almost double the average stock in our database. Net income growth is not as high as the market averages. Otherwise, it would be a growth stock. And the revenue growth is almost as high as the average stock. So the stock is pretty good considering it's an income stock and a REIT. Now, the retention rate is 0. In other words, how much money is the company putting back into itself in order to grow? And that's nothing, because this is now an income cash cow, as we like to call it. Dividend of 4.9%, and the notes say it is a REIT, again, real estate investment trust, that pays out 95% of all the money after the costs of operating the company. So we like this company, folks. The only thing that worries us is back in the recessionary years where it actually had negative income for a couple of years. We worry about that, of course, but we are looking at a company that has grown very, very nice in the past 5 years and has been able to increase its earnings year after year, and it's been increasing those earnings, and it has been accelerating the increase in earnings, which is very, very nice. And we think that might be protecting us, or protecting this company, against the next recession. So we'll see. It'll be very, very interesting, folks, but we have a pretty good company here.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.